Welcome everyone. Thank you for joining us for today's webinar. My name is Megan Stewart. I'm a Client Director at Vantage Performance, and today we'll be presenting Have You Identified Potential Cost Reductions Within Your Organisation? As you can see, we've got our host Kevin on the screen, along with our guest Jim Cowan, who's Managing Partner at Caliba Group. So before we get started, just a little bit of housekeeping. The session today will go for 30 minutes and then we will have questions. If you have questions during the session, there's a little graphic there describing where the question and answer module is in the Zoom control panel. So please feel free to ask questions during the session, and we'll also have about 10 to 15 minutes at the end for a Q&A session. So without further ado, I'll hand over to Kevin Higgins. So he's the Executive Director of Queensland at Vantage Performance, and he will also introduce our guest.
Thank you, Megan, and welcome everyone again to the Vantage Resilience series, where we talk about all the common traits for making businesses highly resilient. Today we're going to be discussing potential cost reduction opportunities, because that's one of the pillars in highly resilient businesses, is the focus on working capital. And while there's a lot of uncertainty in COVID-19, there's also a re-emphasis on looking at those and reviewing your cost reduction opportunities. So today we're going to be joined by Jim Cowan. He's the co-founder of Caliba Group, and he's also the managing partner for Australia and New Zealand, and he's the lead for the heavy industries sector, which we'll have a bit of a focus on today. Jim started his career in agriculture and manufacturing, and he moved into procurement consultancy after that. He spent 6 years in the mining sector with Anglo Coal in strategic procurement roles, and including management of mining equipment, mining services, strategic supply. He's got an agri-science degree, MBA, and Six Sigma trained. So welcome, Jim.
Yeah, thank you, Kevin.
Well, we might actually, before we traditionally start off with some poll questions, but I think, Jim, if you can just tell us a little bit about procurement, because people often think it's about price, but it's more about, there's more to it.
Yeah. Okay, when we look at procurement, it's not just about price. We look at, I know it's a bit of a cliche, but the iceberg, the tip of the iceberg is price. That's what many people look at. What price you pay for that, what price you pay for this. But below the waterline, there's a whole heap of costs associated with procurement. One is volume. How much of it do you use? There's things like inventory holding. There's excessive waste. There's your processes on how you actually procure. So it's not actually the cost of goods or service that you get, but how much does it cost to actually get it? The people, the processes, do you over-specify your products? Are they, instead of getting a Rolls-Royce specification, does a Holden specification suffice? So there's a whole heap of underlying costs that contribute to procurement, and price is just one. Price is very important, but getting that volume down and getting the cost associated with procuring items down as well. So, and also there's things like the market and how you treat the suppliers. It's something that we don't hear too much of, but you can really damage your reputation in the market by not treating your suppliers right. If you manage a tender process and you don't deal equitably with your suppliers, you can really damage your reputation in the market with your supply base, and that's a real cost to the business, because next time you go to market, guess what? They're putting their prices up, their rates up. So yeah, so I guess during this session we'll go through strategies, signs of how we see opportunities, and strategies of how to reduce that cost.
Yeah, excellent. Well, we might start off with a poll question, as we do traditionally, and this question is, when was the last time you or your client or customer So think of your most value, if you're in the financing industry or if you're an accountant, just think of your most valued customer. And when is the last time that they reviewed their the goods and supply contract? So ranging from the last 6 months to the last 24 months to never. So we'll just keep that open for 10 seconds just to set the scene. But obviously a very important aspect of cost control.
Yep, so we'll just close that off now. You'll see the results shared to your screen. So as you can see, half of you have reviewed within the last 6 months, and then the rest are, over 12 months, or a couple have never reviewed.
Excellent. Okay, well, that's probably leads us into the first question. And what do you think are the typical signs that there's actual cost reduction potential within a business?
Yeah. Well, typically when we go into a business, Kevin, we do an opportunity assessment. And quite quickly, when you get into a client, you can see whether there's going to be a huge cost reduction potential or a low cost reduction potential. And things that really contribute to the opportunity, first of all, is the focus. Is that company focused on procurement? Do they have a procurement team? Do they have procurement processes? Do they have procurement systems? Is the head of procurement on the board, on an executive team? So we look at to see how focused they are on procurement, and how people know. Do people know their accountabilities, their responsibilities to procurement? We get in, we ask stakeholders questions, and if they don't know who does what, there's a real opportunity there, because nobody knows who tenders, who manages the contracts, who checks the prices. So the first thing we look at is what's the focus in procurement. Second thing is data. So procurement data. A lot of clients, they buy a lot of things, but they don't record it. If they send out a purchase order, it'll be free text. It'll come back. There's an invoice. They'll pay it. So if a client can't provide us with procurement data, so know, what do I buy? What's the specification? What's the product code? What's the price? What category is it in? If they don't know that, they can't measure what they buy. They can't tender it. They can't record their costs. So what we find, if they don't have the data available, there's a big opportunity, because they don't even know what they buy anyway. The next part is the aggregation and coordination. A lot of business units, there'll be say 5 business units across the organisation, and they don't talk to each other. It's the classical silo approach. Business unit A pays $1.50, business unit B pays $1.60, and C pays $1.80. There's no talking to one another. There's no coordination. The specification at business unit A is different to business unit B and C. So you can't aggregate your requirements and take that to market. So so lack of coordination across the company is a definite sign. Another one that's probably a really obvious one is contracts. Do you have any contracts in place? And it is very surprising that at some big organisations there's a lack of contracts. There's still, in today's world, there's handshake agreements. There's we agreed that we'll pay this price for this term. So just lack of contracts, lack of how do we increase or adjust the price. And no KPIs for measurement, no KPIs for supplier performance. So they can't rate or can't even measure how those suppliers are performing. So again, lack of contracts. We also look at how often do they engage the market. We just had a poll there. It was quite interesting that none have engaged the market lately or haven't reviewed their contracts. If you're getting over 3 years, 4 years without engaging the market, there's opportunity. The market goes up and down based on cost, based on indices. And if you're not regularly engaging the market or testing your current supply base, benchmarking, we typically help suppliers benchmark their cost with the market. there'll be new technologies coming to the market that can reduce costs by 20-30%. But if you're rolling along with the same supplier, same services, you won't know that. Of course, that supplier's not going to tell you that there's new technologies out in the market or the cost base has come down. So if they don't regularly engage the market, we know there's a big opportunity there.
Yeah, right. Yeah. Okay. So I guess when you're out kind of day one on site, assessing the landscape and the procurement practices within a business, what are those poor practices that have a massive impact on a business?
Yeah. So the practices of obviously going to tender. So first of all, actually going to tender, we just mentioned that. But companies, when they go to tender, even right up front, they don't define what they want. What do you want? How much do you want? What's the specification? So not being clear on actually what you want, and then engaging the market, not having proper strategies, not negotiation strategies. What do we want? What are we going to negotiate? What can we give away to the supplier that's not a value to us, but a big value to the supplier? Term of contract, security of supply, so they can invest in capital equipment, in expansions of manufacturing. So getting that defined up front, negotiating properly, and having a definite objective of what you want to get out of that tender. So that's the first part, is getting the outcome from a tender. But what we find, companies always celebrate when they go to market and they get a good price. We've reduced our price 20%, over $10 million for this service, and great. So we're going to lock that into budget, and we're going to save X amount per year. Well, it doesn't work like that. You've now got to manage that contract. So you got to manage the performance of your supplier, and typically the contract does get handed over. A lot of the time, the tender team doing the contract doesn't manage the contract. They'll hand it over to the business or a contract holder, and they won't tell them how to manage the contract, what the price is. So already there's value lost there. And then you go to the next stage of KPIs, knowing what those KPIs are. There's and just generally lack of performance management, lack of tracking the pricing in contracts. So quite quickly, a 20% benefit that you get from a tender can be lost, over a period of 6 months back to where you started from. I think we had a graph there that illustrates that without the proper contract management, all the value falls away. So you might hear about, there it is up on the screen there now. You see if you employ some good practices during the tender, you must hold on to those during the contract management phase to maintain that value. So, and what you might hear called is the procurement cycle. You've got to manage the procurement cycle. You can't have any one phase in the procurement cycle missing, otherwise the value is just going to fall away. Yeah.
Okay. That might actually lead us nicely into our second kind of poll question, just to make sure everyone's awake and engaged. But we're going to talk now about what percentage of your clients or customers spend is under contract. So it varies from none to 100%. So what's under contract? We'll give 10 seconds for that. And then there's a second poll question as to how many people do you have within your organization, or do your clients have within your organization, that actually manage the goods and services contract or contracts. So I'll give you another 10 seconds for that.
Yeah, so I've just got about 30% of people that have voted so far. So it's just trickling into the second question. Just close it off in 5 seconds or so.
Think about your most valued client as well if you're an advisor when answering these type of questions.
Great. All right, we'll close that off. So you'll see those results just come up on your screen now. So I'll let you talk to those results there, Jim, but that first question is what, 50% is the primary answer there, which is 50% of their clients' customers is under contract. And the following question, it seems the bulk of the responses is that they have 1 to 2 people within their organisation or the client's organisation to manage those contracts.
Yeah, no, good. Yeah, it's sort of all depends on the size of the organisation. The bigger the organisation, I guess, the more numbers you'll have in the procurement team. Yeah, so it's
good. Well, that might lead on to, I guess, the meaty part of the conversation.
Yeah.
So, what are some of those key cost reduction strategies that businesses should be looking at?
Yeah. Well, when we go into organisation, I guess we go with a toolkit, so to speak, and there's always levers that we can pull, and I think it's up on the screen there now. Levers that we can pull in terms of how we get costs down. So first of all, we do an opportunity assessment to see where the value is, and then for each of the spend categories, we apply different strategies. I think so. The first strategy is, and we've mentioned it in some of the signs, is aggregating, getting all the spend together, getting common spend together across the company, defining the requirements, what actually are they, so aggregating it across the business unit. Also, we look at the pricing for common items. We call it price equalisation, picking out the lowest price for the same item across the business, and making sure. And these are the easy wins. You know, that can be just done overnight. Aggregating, we look at the number of suppliers too in this aggregation strategy. Typically, suppliers have a long tail of suppliers. They'll have some key suppliers where they might spend 80% of the spend, but then they'll have a long tail of suppliers that are in their system. They got to manage, but don't spend much with them. It's probably a bit of contract leakage that they do spend with these tail suppliers. So getting rid of some of those tail suppliers and giving that volume to your strategic suppliers. So it's about aggregating and taking that to market. And that feeds into the second strategy, standardizing your specifications. In the mining world, a lot of work there is getting standard specification across mining sites, even for mining equipment. One site might say, I want my cameras, my reversing cameras on this side of the truck, and the other site will say, I want it on this side of the truck. I want this fire suppression on this fleet. I want this fire suppression on this fleet. But standardizing specifications across the business, combining with aggregating volume is one of the key areas that you're going to reduce costs.
Yeah.
It's one of the big things that we look at. But a barrier to that is stakeholders, getting stakeholders on board. There's going to be a lot of, would say, a lot of personalities out there that want, whether it's healthcare or whether it's mining. In healthcare, it's probably your surgeons. In mining, it's probably your mining engineers and your GMs of the site. You've got to get them on board to standardise your specs. So that's a big challenge that we find, and to standardise the specs. So that's the first two strategies. The second strategy is just reduce what you buy. Reduce waste. One volume of something you don't buy is automatic cost reduction, so you don't need it. We work on strategies, and these ones you probably can't get overnight. More the longer term strategies of, for example, fuel. Fuel for heavy industries is a massive cost, up to 30% of the overall cost. So 1 litre saved of fuel goes straight to the bottom line. Working on fuel efficient projects and so on, but also PPE. Looking at PPE, the waste that is in PPE, coming up with some strategies to reduce waste, so you get your actual volume down. So the volume times price is going to reduce cost. Another area is your process and your systems. So actually, the systems you use to actually procure the items. Try and get that cost as low as you can. If you've got some processes that are a high volume, automate them. Get some technologies in that automate those processes, so the cost of buying a unit is down. Also on the processes side is inventory. Why hold all this inventory when your suppliers are an hour down the road? Minimize your inventory, maximize your working capital so you can spend on other things, but work with your suppliers to get that inventory down, to a level that you're comfortable with, that you can operate with. So that's another area that we do look at. Another thing, and we've mentioned, is just contract. Just get what you buy under contract. Yep. It minimises risks. You can negotiate price, and it's a very quick one. A lot of the cost savings we get from companies is instantaneous. We can sit down with the key suppliers and actually find out what they want. Not many companies would go and ask, what do you want to your suppliers? And what's of value to you? And a supplier might come back and say, if you offer us, if you raise the 1 year contract to a 5 year contract, well, we could invest in this, we can improve our process, and guess what? That's a 20 to 30% reduction for you. So it's finding out what they want and helping them to achieve that. And payment terms, just asking the question. We're on 14 days, can we go to 30? Sure. So just asking the question with contracts. So payment terms, term of contract, anything that you can give away as a concession in your contracts can considerably reduce cost. And then the last component is the contracting model, finding out the best way to contract with your suppliers to get the best outcome. Too often these days, companies think they can do everything. What is your core business? Focus on your core business and contract out what's not core. We help out a lot of companies with managed service providers. At mine sites, there's camp facilities and so on. A mine site's not good at serving up food. They're not good at maintaining houses. They're not good at cleaning. So contract that out into a managed service provider setup. Or if you have a guaranteed volume that you want to go to 1 or 2 suppliers, negotiate that and give them a guaranteed volume where you can get a good price. So just finding out what model suits what type of arrangement. Other models are panel arrangements. So if you're not quite sure what your ongoing supply volume is going to be, put some panels in place. Get all your terms and conditions agreed up front, and then all you've got to do is then issue a purchase order to the best price at the time. All T's and C's are agreed. Keeps your cost of procuring items down, and you've already got terms and conditions and schedules of rates agreed. So it's actually the contracting model. So if you look at all those 6 strategies, you bring them all together, and we sort of pull different levers with different types of categories, and to get the best result for the client.
Yeah. Okay. Interesting. And I guess some of those cost reduction strategies, some are complex to negotiate.
Yeah.
Some are easy.
Yeah.
What do you think, as far as the key cost reduction areas, what are the not too complex things to achieve?
Yeah.
If someone were to go away tomorrow and start doing that.
Yeah. First thing we do is look at your contracts. Just do a review of your contracts. Finding out what's in the contracts, what are our payment terms, what are the prices. Perhaps do a quick benchmark to the market. Just finding out what is the price in the market, what volume do we buy. Is there an opportunity for us to go and negotiate with our key suppliers? Don't be afraid if you've had a strategic supplier for the last 10 years. They've been very good to us. You've been very good to them. You've been giving a lot of business. So don't be afraid to ask the question on a better rate or a better price. Secondly is aggregating. Finding out the specifications. Is all our volume in this contract? Do we have contract leakage? Do we have a long list of tail suppliers that we can sort of bring up and allocate to one supplier to get a best deal? And that can be done very quickly.
Yeah.
It's some of the process things about automation, getting in technology. That's more of a longer term strategy. But looking at contracts, getting rid of your tail and allocating more volume to key suppliers, reducing waste. Yeah. Find out how much inventory you've got. Do we need that inventory? Can our vendor hold that inventory in their warehouse, and we only get it as we need it? Free up millions of capital to allocate elsewhere, and let your supplier hold the inventory. I would say they're
The two big.
They're the ones you can do and get them done in a week.
Yeah.
But there are some other longer term strategies you can put in place.
Great. Okay, I think we've covered a fair bit in that session. Time's flown a little bit, but we might not some great insights into there. As far as just to visualize this, people. You started off by saying people focus on price, but if you focus on cost as a strategy, what if you just kind of talk us through what the impact of that is?
Yeah, that graph you see there is in those first two sections there. As Kevin mentioned, that's negotiating around price. Suppliers' costs will go up and down depending on some indices in the market around labour and steel and so on. And you will negotiate price over time. Sometimes they'll make a bit more margin. Sometimes you'll get them down to a lower margin. But the real benefit comes into working with your suppliers, finding out how your supplier can reduce their costs to supply you. Yep. You want your supplier to have a fair and reasonable margin. If your supplier's not making a margin, they're going to go out of business, and you don't want that. So how can you work with your supplier to maintain their margin but get their costs down? Standardizing your specifications, giving them longer term contracts, working with them to improve deliveries. We don't want a ute load anymore. We're going to get a semi-trailer load. It's all those things where you work. How can I work with my supplier to reduce their costs? And also letting your suppliers in. Your suppliers and are typically it's their core business. They're experts at it. Typically, a lot of companies we see think they can do everything, and they just deal with their suppliers on price. But let your suppliers in and work with your suppliers to get that cost down.
Yeah, excellent. Oh, some great insights there. We may have some questions, or we may not. We might have just answered them all. Jim might have answered them all in the last 25 minutes, but I'll hand back to yourself, Megan, to moderate if there is any questions from the floor.
Yeah, thanks Kevin, and thanks Jim. That was very informative. So we do have a couple of questions in the question bank, so I'll start asking those now, but please feel free to ask some questions in the Q&A panel at the bottom of your Zoom screen. So the first question we've got here is kind of alludes to one of your last points, but what is your experience with clients who think they can do this themselves and save money, but in reality, they don't do it at all, or they don't do it properly?
Yes, it's we see this one quite often, that we'll come in, particularly after doing an opportunity assessment, to say, look, there's 10% in it. And then we hand the report back to the client. They say, don't worry, we can do that. Majority of the time it doesn't happen, purely because they've got so many other things on in the business. They got other competing priorities. Whether if we go in there, we focus completely on that task and get the job done. But we'll check back in with companies, and typically they don't implement it. And we'll keep asking the question, and so a lot of times it doesn't happen purely because they don't have the resources and internal capability to do it.
You sound like a broken record at times, because you got to manage it, I guess, each state well throughout the life of the contract. So it's not something you want to fall by the wayside.
Yeah, so we've got another one. I won't share the question itself because it's got some client data in there. But the question is, it's more a statement. One of their clients has seen the overheads rise from 14 to 19% of revenue over the past 5 years, despite increasing revenue. How would you help in that sort of scenario?
Yeah, okay. Well, first you have to, it's all about data. You've got to delve into what's in that overhead, and finding out what it actually is. Some industries, the overhead portion is particularly capital intensive businesses. The overhead is quite high. So it's actually getting an understanding of actually what's in that overhead. it may well be justified. With labour prices going up and building rents going up and so forth. So it's actually finding out, drilling down into what's causing to the components of the overhead and looking at indices to see where they should have gone.
Yep, no, that's fair. So I've got a question, this is an interesting one. So it's saying, what if the benchmark shows that we are locked in at the best cost-effective rate or supplier, but I'm still being pressured by my CEO to continue to reduce cost? How can I support that request, or I guess give the CEO feedback that you are at the rock bottom price?
Benchmarking studies are very good. Finding out in the market at any point in time a price for your volume in the market and showing your executives that. But that data is not always available. That's what we find is the problem. Not everyone has this benchmarking data. Sometimes you've got to actually go to market to find out what the actual market price is. So to find out that you've already got the best price, just benchmarking and showing the CFO that you have benchmarked from a reputable source. If you don't have the benchmark, the only way to find out is go to market and prove it. Yeah.
Sorry, is that something that you see often coming into clients basically to justify that they are at the best rate?
Yeah, but what we find is typically clients say that they are on a very good rate, and we ask them, "How do you know you're on a good rate?" And they say, "Look, we've got a strategic supplier. We know they treat us well, and we ask, just give us one project, and we'll test the market." And sometimes we've got between 10 and 20% reduction on with their strategic supplier. So it's and also we can bring in, because we go to the market so many times, we can bring in benchmark data ourselves and compare that to what they have and show them that their price is very good, and we'll tell them straight away, or if they're above the market.
We've got plenty of questions coming in, so we'll just keep going through them because we've got plenty of time here. But so this is one, I guess we certainly find this as external consultants in the turnaround space, but it's obviously different in your space. The question is, do you find that clients don't ask the hard questions as they want to preserve the relationship, but you can go harder as you don't need to preserve the relationship as much? You're an external consultant.
Yes, we find that. We find that we can come in and be the bad guys because we don't have to hang around and manage the contract and manage the relationship. We can come in and facilitate the process and but not be firm but fair. Ask the challenging questions, and generally when we leave, that both parties are happy. The supplier's got a five-year renewed contract, and the client has a reduced price, but now a better working relationship with the vendor.
Good to know. It's very often the case with external consultants in any area, isn't it? So we've got another question here. How do you tackle getting buy-in from key users or risk-averse end users to consider different specifications or trial new products? So I suppose the question is, if there's a product that looks better or more efficient or cheaper, but people are reluctant to try it, how do you get their buy-in?
It's all about stakeholder engagement. What we find, you've got to users. You've got to sit down with them. You've got to get credibility. You've got to know what you're talking about. You've got to know the content. You've got to go away and study. And we find it in healthcare. You've got to know the product. So when you're speaking with the surgeons, you get credibility. You know what you're talking about. And when you get that credibility and you get that trust, they start listening to you, and you can bring a new product and trial it. And then when they see the trial data, getting to that trial is the first step. When they see the hard data in the trial, then they're prepared to change. But yeah, stakeholder engagement is number one, and getting key stakeholders on side to make key changes within the company.
Great. We've got a very specific one here, but they're asking what are the best resources, as in schools, books, courses, certificates, etc., available for procurement professionals in Australia to develop digital skills and embrace the digital transformation on the procurement side of things?
Gosh, that's a specific one.
Yeah, very specific.
Yeah, look. There's good courses out there. Our team, learning on the jobs is the best way to do anything. But yeah, there's digital. I can't be specific in naming any one course, but yeah, definitely there's a lot of technology out there at the moment in terms of platforms and. But a lot of the skills in procurement, these are the softer skills. Yeah, people can learn the hard and fast. How do I run a tender? How do I put tender documentation together? But I think what's lacking at the moment out there is some good soft skills, some good old-fashioned negotiation, building trust skills. And so if people are looking to improve their teams, yes, you need the hard skills, but definitely don't forget those soft skills, and particularly how to manage stakeholders and how to negotiate.
Yeah, sounds like a question that should have been there last week on our digital best practice webinar. Probably, I'd say refer to that one for last week. Red Digital did a really good piece on that.
Yeah. So we've got a few more questions here. I'm just going to combine a couple. So one of them's asking, in the current environment, what should companies be focusing on right now? And we've also got a question asking, how has COVID-19 influenced the way you approach suppliers for business savings? If at all, has it changed at all?
With COVID at the moment, well, supply chains with COVID have been affected. So our mining clients and healthcare clients, we've heard it in the news about PPE. Going to be working with hospitals there to ensure they get PPE supplies in. So
that's all the protective gear and the gowns and whatnot.
Yeah, personal protective equipment. I guess ensuring the right level of inventories. So insurance stocks. This has been a once in 100-year event, and will it happen again? Don't know, but having proper inventory strategies put in place to cater for unforeseen events. It happens a lot in the mining sector, insurance bears and so on. So to answer your question on the COVID, it'd be around reevaluating your supply chains. Do you want to source everything, or your low cost items from China anymore? Well, maybe a lot of companies are reassessing that to go to other low cost country sourcing regions, or looking to source locally. I think there's going to be a big move to sourcing locally
by Australian.
By Australian. Yeah. And it's not just saving costs at the end of the day. It's also supporting communities.
Yeah.
And big drive now is getting businesses up and going. I think a lot of companies do want to be part of that and support local.
Excellent.
Great. So we've got another question that ties into that really well, actually, asking, with everyone aware of recent global supply chain disruptions, how should we balance holding sufficient stock versus holding just-in-time stock, which would be cheaper for the company? And I guess, is that something that you assist with at Caliba as well?
Yeah, it's looking at, and every item is different. Every item has got to be looked based on the risk to the company. We work with clients in terms of looking at their inventory and going through the risk to the business. Obviously, there's security spares and items that companies will keep, because if they don't have it there, the operation goes down. But if you don't have a pencil in the drawer, will you keep operating? Yes, you will. So it's looking at every item individually and coming up with a strategy for each of those. And it's based on the risk profile of the company. Some companies want to maintain more inventory due to disruptions happening. Well, that's their strategic decision, and they'll wear that on their balance sheet. Others want to a bit more risk adverse, want to make more profit. Therefore, they'll push the boundary a bit. So it's working with clients on individual products and with their risk profile.
Great. So we've just got one last question to close up question and answer time. So it's in a similar vein to the difference in being an external consultant versus an internal sort of procurement team. But the question is, do you find that you are able to deliver market activities such as a large strategic procurement exercise a lot faster and more efficiently than procurement teams? And if so, why is that the case?
Yeah, we find that we do, because we talked about it before. Internal procurement teams have got other things on their plate. They got meetings. They've got other pressing priorities. When we come in, that's our sole focus. Our sole focus is to get across the business and to achieve the savings. Also, there's typically an announcement made that there's a consultant here, and so we get given the information. We can collect the information quicker. We can interview, and stakeholders give us their time, but they might not give the time to the internal procurement team. So information, time, and we generally are quite aggressive, not aggressive on our timeline, not aggressive with the way we deal, but because we can get our experience in moving projects along, dealing with stakeholders, we can complete them quicker and typically more thorough. And it's no disrespect to internal procurement teams. They do their job, and they've got other things on their plate. But our sole focus is to run these projects, to pull cost out of the company, and it's not the hand grenade over the wall, so to speak. We make sure that there's sustainable savings, and there's processes in place to maintain those savings. So yeah, shorter period of time, and you get the savings quicker.
Great. Okay.
Great. We've just got a few more questions here, but we're running short on time, so we'll just answer all those questions offline. We've got everybody's email, so you'll just receive an email with an answer to your unanswered question. But I think just to close it out, we've got one question, Jim, just asking what your typical engagement looks like. How does it start? What's your sort of cost versus client saving? Does that have impact on your fees?
Okay. Our typical engagement would be you come and do an opportunity assessment. We get all the suppliers' data, what they buy, their contracts. We review that. We interview some of their key stakeholders in terms of the history of the company, and then we'll put an opportunity assessment to them. And then if they're happy with their fees and the savings that will be achieved, we typically engage then in a phase 2, which would run from 6 months to 18 months is typical. And fees are flexible and based on lump sums and risk shares, and all very flexible based on clients' appetite, really.
Great, thanks everyone. Thanks Jim, thanks Kevin. I'll just hand back over to Kev now to close out the session and talk about some upcoming webinars we have.
Yeah, great. Thank you, Megan, for moderating today, and thanks, Jim. Some really good, insightful kind of suggestions there for strategies that we can all kind of have a look at, and from a turnaround perspective, and also just from clients and advisors. Ask the question of your clients. It's a good question to ask. Have you considered this in the last, recently? So as you stay relevant with them. So in the coming weeks, we're going to have a few more webinars. The next one's going to be on sales team effectiveness. So does your sales team have the critical skill set needed in the current environment. So you need even the best sales guys out there are feeling it motivation wise to get out there and face customers. So we're going to discuss that with Michael Lang. Strategy, we're actually going to be with insolvent trading relief ending in September this year. There's going to be a focus on whether directors are prepared to invoke safe harbor or not. There's been a bit of a moratorium at the moment on insolvent trading, and also there's going to be some issues around liquidity too coming up. So Michael Fingland, founder and owner of Vantage Performance, is going to be talking about that with McCare in our Sydney office in early July. So that'll be a really interesting topic. And then we're going to be talking leadership and culture, so identifying symptoms and coping strategies for your staff and managing directors during COVID. So there's just a taste of a few to come, but we'll end on that. As Megan said, if there's any further questions, feel free to contact us directly at Vantage Performance. Thanks for joining us today, and we'll see you next time. Goodbye.
Thank you.